I got a massive update on SoFi, and you need to hear this, like you need coffee in the morning. This isn't another noise video. This is a clear, direct rundown of where SoFi is, why the market is paying attention, and what a smart investor should actually be doing right now. The stock is trading up near recent highs, right around $27 a share, with a market cap north of $30 billion. And those numbers matter because they show the market already believes a lot of the growth story. But don't mistake enthusiasm for certainty. SoFi's quarter was impressive. Adjusted net revenue hit about $858 million, and GAAP net revenue showed up at roughly $855 million. And the company reported GAAP net income of about $97 million. Those aren't tiny beats. They are proof that the business is scaling both top line and bottom line at the same time. At the center of this whole move is fee-based revenue. In Q2, fee income topped $377.5 million, a near doubling year over year, and an absolute conversion point for how SoFi is moving from a pure lender to a diversified financial services platform. When a company can pull in stable, high-margin transaction, interchange, and brokerage fees, it's building a moat that doesn't rely purely on interest rate spreads. Member growth is the quiet engine here. SoFi now claims about 11.7 million members and roughly 17.1 million products in use across the platform. That scale means the funnel works. You bring a user in with low-friction offers, you keep them engaged through products that feel useful day-to-day, and you then incrementally sell higher-margin services. The math is simple. More products per member equals higher lifetime value, and the numbers show they're getting better at cross-sell. Why does that funnel matter? Because acquisition cost is the difference between a profitable growth business and an expensive growth trap. SoFi's strategy, low-friction hooks like high-yield checking, easy sign-ups, small bonuses, and micro-products lowers CAC while giving the company a pathway to sell mortgages, personal loans, investments, and now crypto services. That funnel isn't theoretical. It's visible in the revenue per product improvements and the 35% of new products being sold to existing members. If they keep executing, the compounding effect is real and durable. Let's be brutally honest. The crypto push matters. SoFi's move into crypto trading, custody, and even international crypto-powered transfers is a high-leverage growth lever. Crypto isn't a guaranteed home run, but it creates a new fee pool with transaction margins that are much higher than classic lending. International transfers powered by blockchain rails, paired with custody and staking services, means SoFi can capture revenue on flows that used to bypass traditional fintech rails entirely. If crypto volumes continue to expand, SoFi's wallet share of that activity could be meaningful. The key is monetization, not just user signups, but net take rates on transactions. None of this is to say SoFi is risk-free. When the stock runs from undervalued levels to a market cap above $30 billion, expectations are priced in. Margins, growth, and credit metrics must all cooperate. Interest rates still matter. A bad macro shock that raises defaults or a change in the funding cost structure could quickly dent profitability. Regulation is another wild card. The company operates in a heavily regulated space, and any new rules around consumer lending, student loans, or crypto could add costs. So what should you do if you're watching this and considering SoFi? First, don't overcommit at the current levels. The stock is strong, but that strength also means you are buying a lot of expectation. A safer approach is to ladder in. Start with a partial position and add on a meaningful pullback. If you already own a large chunk, take some profits. Then let the remaining position ride with a clear stop in your head. This lets you lock gains while keeping exposure to upside catalysts like continued fee revenue growth, AI-driven product personalization, and expansion into insurance and international transfers. When you record your trades, focus on a few measurable things in the next quarter: fee-based revenue pace, loan platform business originations, revenue per product, and charge-off trends. Those will tell you whether the business is truly improving its unit economics or simply growing top line at a cost. If fee income maintains its momentum and credit metrics keep improving, the re-rating story remains intact. But if fee growth slows and charge-offs tick up, watch out. Another tactical tool if you want shares but prefer better risk control is selling cash-secured puts at strikes where you'd be comfortable owning more stock. It's not a get-rich-quick trick, it's a disciplined way to buy into volatility and collect premium while you wait. Fortuna pro traders use that play to accumulate positions in names they believe in. But like any option strategy, know the assignment risk and have the cash ready if the trade goes against you. The point is to use market mechanics to your advantage, not to gamble. Let's talk catalysts that could push this stock materially higher. First, continued fee revenue acceleration. If SoFi keeps growing fee income at the kind of rates we saw in Q2, margins expand quickly and multiples follow. Second, credit improvement. Lower charge-offs and better-than-expected delinquencies will reassure investors that the lending book is holding up. Third, product expansion. Insurance, workplace benefits, and international transfers could meaningfully increase revenue per member without a linear increase in capital requirements. Fourth, macro conditions. A friendlier interest rate environment reduces funding costs and can bidirectionally help valuation multiples. Price targets are moving. A notable analyst just lifted a price target into the low 30s, signaling that the sell side is starting to agree that the rate outlook and execution justify a higher multiple. That support matters, because when institutional buyers start to mark targets up, it reduces float available to retail and can create momentum. But remember, analysts can be wrong too. They move with sentiment. Use their moves as inputs, not gospel. Here's my blunt take. SoFi is a legit fintech story with real scale, improving unit economics, and a credible path to higher margins through fee diversification. It's not a moonshot, but it is a high-reward growth business that deserves a place in a diversified growth portfolio if you're comfortable with some volatility. Don't buy this because the stock went up. Buy it because the funnel is real, the company is monetizing more products per member, and the next year or two could be materially better than the last. If you want a clean action plan, build a starter position now, set limit orders to add on a 10 to 20% pullback, take profits incrementally if you spike 30 to 50% from here, and always track fee-based revenue and credit metrics quarter to quarter. This keeps you emotionally sane and financially disciplined. The market loves stories, the market rewards execution. SoFi has both right now, and that's a dangerous combination for anyone who doesn't respect the risk. We'll see a lot of volatility. Expect headline news, analyst calls, macro moves, and crypto headlines to create pops and drops. If your plan is clear, those moves become opportunities, not emergencies. Keep tight risk management, stay curious, and if you want to trade option strategies, learn them properly before you place capital at risk. I've been following SoFi since it was a smaller name, and the difference now is scale and proof. They've turned vision into numbers, and that is the moment where the market starts to reward execution rather than just promise. Think in scenarios. In a bull scenario, you get ongoing fee acceleration, lower charge-offs, and a smoother funding picture. That translates into multiple expansion and a move into the 40s if execution remains flawless and macro stays cooperative. In a base scenario, SoFi grows revenue strongly but at a slower clip. Margins improve gradually, and the stock grinds higher with intermittent volatility. In a bear case, weaker macro or regulatory shocks lead to higher credit costs and margin pressure. The valuation contracts and shares correct sharply. Position sizing and mental stops are what separate the investors who survive from those who don't. Be disciplined, not greedy. That's the read. I'm still long, I plan to hold, and I plan to add under disciplined conditions. Read this with conviction if you're going to use it on camera. Say the numbers calmly, explain the funnel like it's obvious, and mean every line. The story is strong, the risk